From Helen Taylor that said, could you review how you come to the amount owed to the investor, please? And so I thought, Eddie, if you would take a moment to talk about what an amortization schedule looks like and why that chart was looking like that.
Yeah, so Helen, what we did is we have built Excel tools to just take amortization schedules. So we took the note, the 5% note, and that was what you saw in the orange, and that was just an amortization schedule that Excel generated. And then we did a layover. So then we laid over the partial, which was in the blue. And that was the amortization of the investor's $70,000 investment at their 9% interest on their investment per year. And then obviously Bob, in an early payoff situation, gets the difference between the payoff to the partial investor and the payoff of the entire note. So we cover these. We really, as people progress in NoteSchool training, where we really have time to show these numbers a lot and change the numbers and show, well, what if this or what if that and stuff. And so people then find out fairly quickly that, they can get a sense of it. And we're just utilizing tools, financial tools. So.
And, I wanted to point out too that the investor, the partial investor, they did get everything. They did get their rate of return. They just got it early. Yes, they invested thinking it was going to be a 10-year payback, right? They were just going to get $8.95 a month, but they got all their money back. And what we found is that when they do that, they're just ready to turn around and invest again. And that's kind of the way that whole picture works as you go through. So
this case study, one thing about yield, because I have discovered people will get drunk on yield, right? Bob sold this loan about 6 years ago. And at 6 years ago, 9% return was probably a good return.
Right.
The return in the marketplace for rental properties and other investments has continued to go down, right? So the return on that investment has declined. And today, Bob, I would guess that closer to about 6% if you sold a partial today is about where you would be.
I would agree. Yes, definitely.
So that becomes more relevant to the market conditions. So all great questions there. And once again, I will say this about yields and amortizations and stuff. Sometimes we're seeking kind of the punchline answer, and there's enough. You have to build a little bit of a story before that punchline answer makes sense like it does to you now, Bob. But the answer is you bought the whole pizza, you sold less than half of the pizza, and you didn't know it was going to pay off early, but it did, and all of a sudden it just made you didn't get as much money as you would have gotten had it paid out over time, but you got another lump sum of money of $100,000. Now your retirement account grew from 11.5 to $100,000, and now you could go do 10 partials.
And that's on one transaction, guys.
In fact, I did reinvest it.
Oh, we know you did, right?
We're not surprised.
Yeah, absolutely. And for those of you who are newer and you're trying to figure out why would someone take 6 or 7% if they could have 9%, you got to understand market conditions, like Eddie said. But the other thing is this: the thing you might have missed is the risk associated with the partial, right? This partial investor is truly passive. If anything was to go wrong, Bob is on the back side of this note. He doesn't get any of the payments until the partial investors is taken care of. And so he's going to mitigate that risk on their behalf and make sure this thing performs, because Bob wants to get paid, right? And he wants this thing to go smoothly. And so this is another reason that the yield starts to come down when you start taking more and more risk off of the table, the rate comes down. And how do we know this? Because when you put money in a bank, do they pay you 5%? They don't, right? Because your risk is extremely low. So hopefully that kind of helps answer some of that stuff.